So you're looking at major indices versus major currency pairs. Major indices are 1.5 to 2 times more volatile than major currency pairs historically. And that's over 50 years of data. So it's pretty significant. What I would say is split up your positioning and be a little bit diverse, where you've got exposure to equities, at least half or the majority, commodities and forex, and maybe some cash and interest rate situations where you can take tiny positions or day trade essentially with opportunities that happen in very small periods of time. I think your time horizon really, if you're starting out, should be 1 to 3 months on every position across the asset classes. But percentage split, personally I do 65% equities because that's probably the most volatile asset class, 20% commodities, 10% in forex, and keep cash or margin in reserve so you can actually take advantage of very short-term opportunities.
Anyone else? Yeah.
For example, when you want to start trading, the first issue coming with it, you have 100 different brokers, and in your opinion, which criteria should we use to find the right broker?
I think it's important to know whether the broker's taking the other side of your trades, first of all. So, I mean, what you'll find, there's a lot of conflict of interest in the industry when you're a retail trader. There's obviously the commission situation and the spread situation. Just because spreads are tight and commissions are low doesn't mean it's a good thing, because all that means is that the brokers are going to try and turn your account over more aggressively so you pay them as much money. So they'll be telling you to do things that aren't necessarily good for you. So obviously cost of trading is an issue, but I think it's really important that you find brokers that aren't aggressively taking the other sides of your trades, because that's a huge conflict of interest. So in the products like spread betting and CFDs, a lot of them still do. So they go unhedged on the other side of your positions. So they would actually prefer that you didn't make money.
We'll take one more, yeah?
So you see sort of the big kind of downside of brokerage fees reducing, in the future obviously cracking down. Trading obviously has always been divided between trading and broking. Obviously is you see what the brokerage can take more of an advantage in that sense of the like you said, that chap there, trading in that sense.
Listen, there's no doubt about it, trading's become cheaper, which isn't great for the brokerage industry. But what also happened for the brokerage industry in the last 10 years was the switch from dial-up to broadband. So the market size is now much bigger than it was 15 years ago, because now everybody can trade from their bedroom. So the market participants are far greater than they used to be. So the brokerage industry overall has been downsized. I think broking actually, when you're starting out in the markets, it's quite good to be a broker for a couple of years, because you can learn a lot of things that happen on the other side. So when you actually go out and trade with your own money or other people's money, you know where the conflict of interest lies. Yeah. So you can actually talk to people in this language and totally understand their business. So I think it's quite healthy to do it for a couple of years, because you'll learn about it. My function in the investment banks was twofold: market making and proprietary trading.
Is it easy transfer from broking to trading?
It's not that easy, but as long as you go into it from the outset and say, I'm only going to stay a couple of years, and make people that you want to work for understand that the reason why you're doing it is to learn, not for the money and to rip people's faces off. Then it's okay. It's quite healthy. People will look on it favorably, but you've got to obviously have context, and you've got to go into it with the mindset that you're not going to be there forever. You're only going in to learn so you can go elsewhere.
So you've worked at 3 of the biggest investment banks. Would you say there's much of a difference in the culture, or the culture of success between the banks?
I'd say there's a massive difference between Goldman Sachs and the rest of the market. Obviously, I'm going to be biased because I started there, but back then, even I would say even now, like the best people in the market work there, and they're not unapproachable people. They're generally just normal people, but with a very strong work ethic and intelligence. That's a different type of intelligence to the rest of the market. It's a curious mind, but with a very, very strong work ethic, but also very entrepreneurial as well. Being able to create new products, create new situations that there's going to be a lot of demand for. And this type of innovation, I think it's very important in financial markets, because to satisfy client demands in financial markets is very, very tough, because it's a very overbroked market. Goldman are head and shoulders above anybody else in terms of doing that. So if I'm going to be biased, obviously the culture there is very, very different to the rest of the market. For me, the culture when I was around, because I think it's dependent on the time that you're in the market, the time you're actually a professional. I saw the culture in the city generally change from a culture of working for the company and making company profits to a political culture of greed and trying to make money for yourself rather than for the benefit of the company. So because there was a lot of capacity and a lot of slack in the industry at the time, a lot of people who were very untalented were being hired to do very important jobs. We saw what happened in the end, but the industry now has the capacity's tightened to a point where it's getting to a stage where it's about right. But back then, because of the capacity issues, the culture was very, very self-interest motivated, and a lot of it was greed, with a lot of people who were very untalented working in very important positions.
What kind of account sizes were you managing by the end of that investment banking career?
Yeah, the largest account sizes were actually at Goldman, because there's more of a risk culture. So started off with like $10 million on day one. The more money you make, the more you progress. When leaving Goldman, there was a team of us, 4 people, running about $500 million on the trading desk, which was about a quarter of the trading desk's exposure. So it was the number one team. We were doing TMT, so technology, media, telecoms. Then Lehman Brothers, very strange situation. Walking in, most guys around me didn't have more than $10-20 million of risk when I arrived. Within 2 years, this was 2004. Within 2 years, everybody had $200 to $300 million of risk. So, really at that time, guys like me were brought in to raise the risk profile of the desk. To say that it got out of hand is an understatement. That's one of the reasons why I left Lehman, because a lot of people around who were there previously with very little risk exposure, in a very short space of time had a lot of risk. So not necessarily deserving that risk. Then JP Morgan, same situation, hardly anybody had risk around. But then I come in and ended up with $100 million of risk as the limit. So at any time, $50 to $100 million. But the biggest risk run is probably like $200 to $300 million personally, but working in a team on 500.
What about the work-life balance? Was there a work-life balance?
Forget about work-life balance in those days. It just didn't exist. I remember, a typical day was wake up 5 o'clock, taxi drivers outside at 5:30, and you're in the office by 10 to 6. Then the market closes 4:35, but then you're trading the US till 9-10 p.m. in the evening. And then if you've got situations in Asia, then the traders in Hong Kong will be calling you at 2 in the morning. And then also there's a social side to the business where obviously in a bull market, traders are asked to go out all the time with the salespeople because the clients want to meet the traders, as in the people who are trading their positions. So you typically be out 2 or 3 nights a week till 1, 2 o'clock in the morning. I remember one situation stands out, in my mind in terms of private life. I remember starting to date this girl, and then after a couple of months, we were getting on very well, and she lived around the corner from me in North London. So I said, well, why don't you just spend more than a few nights a week here? Why don't you just pretend to move in a little bit? Put some clothes in the wardrobe. But I spent a month basically telling her and warning her, you're not going to like it if you live with me. She's like, oh no, it'll be fine. She told me for months, it'll be fine. And then I came in from a client night out one morning at about 3 in the morning, fell on the bed, slept in my suit, got back up, 5 a.m., got under the shower, put a new suit on, and as I was getting dressed, because I used to have to get dressed in the dark, because that would wake her up, as I was getting dressed, I could feel this presence behind me. And this was after about 2 weeks of her kind of moving in. And I kind of turned around, and she was standing on my bed, holding her hair in bunches, and just screamed at me, "What the hell are you doing?" And my response was, "I guess the honeymoon period's over then." And we had to discuss the whole situation when I got back that evening. But essentially, private life, Monday to Friday, awful in that market. Weekends, catching up on sleep. and then it all starts again Monday morning at 5 a.m.
We'll take some more questions from the audience, if anyone's got any.
I was just going to ask about banks. You said Goldman Sachs is head and shoulders above the rest. But are there any banks that you think are moving sort of up the chain and are kind of going to be the ones to look at in the future?
It's difficult to say because I think since the subprime crisis, overall, the standard of people within that area of the finance industry has decreased a lot, simply because the compensation has been crushed.